elevated inflation and geopolitical uncertainty. So if you are nearing retirement, is there a way to protect your portfolio from the effects of a potential recession? Cristina Guglielmetti is a certified financial planner at Future Perfect Planning. Cristina, good morning to you. Is that even a thing? How do you even go about recession-proofing your portfolio?
Hey, good morning, Brian, and thanks for having me. The way I like to work with clients is to try to be very forward-looking and to understand that, there will be times of political unrest, there will be times of inflation, the market will drop. And generally what I advocate is, kind of a bucketing strategy. It's a classic way of creating a retirement plan. And that's when, you have a short-term pool of money to draw from, and that's what's meant to cover your expenses, for the next few years. And typically, we replenish and we rebalance that portfolio, so we can replenish the cash, maybe a couple of times a year. What we could do in times of rising prices is just do that a little bit more frequently. So maybe instead of twice a year, you do it quarterly, and you just keep an eye on the level of cash, so that we always have a decent amount available. But I don't like to make big changes to the portfolio. I really think that times like this is when the rubber meets the road, as we say in financial planning, and when it really is important to stick to the plan and not to try to anticipate what's going to be happening. We've seen in the past couple of years that things move very, very fast. It was, 2 years ago today that the market bottomed in the initial COVID wave. So, and since then it's been up 100%. So we definitely don't think that we can predict, what's going to happen in the near term. So it's really important to build a plan, build a portfolio that is aligned with your life goals and aligned with what is it that you want to do, what kind of retirement, are you looking at, how are you going to meet your expenses. And we can adjust a little bit, like I said, for rising prices, just by making sure that, we have a little bit more cash on hand. But I generally don't like to deviate too far from the plan as it's laid out.
And so I find, Cristina, it's Julie here. I find that this idea of 3 pools or 3 buckets really interesting here for the different time horizons. How do you then invest in each bucket? Like, is the shorter term, like if you want to take on risk, in which bucket do you put that, for example? Is it mostly a short-term instrument you're putting in the short-term bucket? How do you think about that?
Yeah, so the short-term bucket really should be cash or, cash equivalents, something that's very liquid. You're not going to earn much on it. There's no risk, so it's really, bank accounts. This is something, you could possibly look at, maybe inflation bonds, through the U.S. Treasury, although, you can't access them for a year. So there are some constraints there, but it really should be money that you can access at any time without really worrying that it's not going to be there when you need it. And, the rule of thumb that I use with my clients is 2 years. So we always look about 2 years ahead and try to anticipate what that cash need will be. And it can change. It's not necessarily a static number. Often early in retirement, you need a little bit more than later, because maybe you're retiring before you start claiming Social Security, or maybe before you start to draw from your retirement accounts when you reach, that age 72. So it's possible that later in retirement you won't need as much. But that's why it's important to always, try to do what you can to predict what your income and expenses will be for the next couple of years so that we know, how much cash we need to meet those expenses. So that's the first bucket, the short-term goal. And then the second one is really the one that should be keeping up with inflation, but not taking too much risk. So, inflation bonds may be a good fit here as well. Dividend paying stocks and ETFs are good. And then, to really answer your question, Julie, the riskier assets, the ones that, we expect long-term gain from, should really be in that third bucket.
Cristina, real quickly, before we let you go, should one sell their stocks if they're nearing retirement and they are scared of a recession?
It's a difficult question because, there's a lot of emotion tied up in this. For me, it always comes down to, how are we going to fund retirement if we don't keep money in growth assets? It may be that they're not needed, and there's no reason to take on that risk. But it may be that retirement lasts a long time, and we need that portfolio to last for 30 years. And so if you can't make any changes to your expenses, it may be that we have to keep some there. But it is important to not have the money that you need to pay rent or the mortgage exposed to that kind of market volatility.
Good tips indeed. Cristina Guglielmetti, Future Perfect Planning founder and financial planner. Good to see you. We'll talk to you soon.